Hi guys, and welcome to the channel. Hope you guys are doing okay today. And I know it's been a few weeks since I posted a video, but I did want to give an update of just kind of the chaos of the markets. One thing that I did think that was kind of interesting that's happened over the last couple weeks is my portfolio's hit a new all-time high. Not that I'm expecting it to continue to grow, but it is nice to see that, hey, sticking to the fundamentals, investing, being consistent, not trying to time the market, and just finding opportunity where you can, ultimately it'll pay out in the end. And yet again, another crisis where the markets crashed and recovered everything they lost. It's funny how that happens, and people are always saying this time is different, and oh no, there's going to be hyperinflation or whatever the excuse is. Ultimately, the markets will always recover 100% of the falls 100% of the time. I don't even have to prove that. We can see it throughout history. There's a reason why the stock market has climbed higher over the last 100 years. Some things that did happen over the last couple weeks are kind of interesting. Initial jobless claims for the first time in since early or towards the end of March. We saw initial jobless claims drop below 1 million. Unfortunately, they jumped right back up to above 1 million last Thursday. What does that mean? Well, remember, initial jobless claims is just people who are filing for unemployment for the first time ever. This isn't people who are consistently filing for unemployment, but a first-time appliers. It's good to see the downtrend, but it's still nowhere near the historical average of 200,000 to 300,000. So we're gonna have to keep an eye on it. I mean, it's still ridiculously high. Even in these marks, you see, even all the way back to the 70s, it's never really been this high before. So only time will tell what will happen. Some other interesting stuff that happened this week is we saw Apple. They hit new all-time highs and be the first company in the world to be worth $2 trillion. What's kind of crazy is to think not even a year ago, back in March, this stock was barely worth $1 trillion, and since then has rallied up and doubled its value in less than 6 months. That's not normal, just so you know. It doesn't happen often, and congratulations to anyone who bought at the bottom or who's been holding the stock for the long term. I mean, if you own an index fund of any kind, more than likely or not, you're going to have a decent percentage of your money in that fund is already invested in Apple. For example, the NASDAQ, it's over 11% currently. It's not something that we're going to continue to see grow, and I think people need to understand that. Like, there are moving averages, there are 50-day moving averages, 200-day moving averages, and 30-day moving averages, and usually stocks don't like trading too far away from their 50-day moving average. And right now, Apple, as well as other companies like Tesla, are trading way away from that moving average. And what usually happens, we usually see some kind of correction, and they usually come down, settle down to where that moving average really is. Right now, it's still kind of up in the air on when that will happen. I think that the markets are kind of losing steam. We see volume slowing down because volume slows down this time of year. Less people are trading towards the end of the summer, but markets are still sitting way above where they should be. It's great to see, but the nice thing is that when stuff like this happens, we have to remember that markets will fall. It's easy to get comfortable that, oh, they're just going to be climbing. And we can even look at my portfolio. Basically, since March 23rd, we've seen nothing but growth with a couple hiccups here and there. But for the most part, it's just been growing and growing, primarily because the markets have been growing higher. I've been averaging in at lower prices, and I've been trying to find opportunities anywhere I can. We also want to look at Tesla real quick. So Tesla hit a historical landmark, being worth $2,000 a share. It's amazing. It makes me a little salty because I used to be a Tesla shareholder with a cost basis of about $240. I sold out about $1,000 the first time it peaked, right before the market crashed in February, and I reallocated a lot of that cash into safer and broader funds just because I'd already made a 300% gain, and I didn't see the point in holding 20% of my portfolio in a company that isn't necessarily profitable yet. And of course, now they are profitable. But we also have to remember is I still like to invest in core fundamentals, and I think Tesla, just in the last month, you see it's just trading ridiculously. We see August 11th, it was at $1,300 a share. In less than 2 weeks, we're seeing a 50% gain for a company that was worth $200 billion. Now it's worth $382 billion. I mean, that's obviously just the value of the company. But we have to remember, like, what does it mean to be an investor? And at some point, you have to look at the fundamentals. And I understand Tesla's ahead of the game, and I believe in their business model 100%, but I don't agree with the valuation. I think it's way overhyped, and too many people over the last year have been flooding into the stock, trying to chase it, and so far it's worked. But eventually, this stock's gonna slow down. There's no reason why, or its lifetime, we see that it has these exciting run-ups, and then it just kind of flattens out. And really, the majority of the growth happened over the last year and a half. And it's gone so parabolic. People go, oh, Tesla is going to be $7,000 a share. Yeah, maybe, maybe in 15 years. But right now, it's valued more than JP Morgan. It's valued more than MasterCard. It's valued more than Walmart. And this is a company that hardly makes a profit. Yes, they are building, technology for the future, but fundamentally, this company doesn't make that much money, and we're paying price to earnings ratios of 1,000. That's ridiculous. You could consider a high growth stock, maybe we're paying a price to earnings ratio of say 40 because they have high expected earnings, they're expected to grow 20-30% a year, and they're making a profit, and that's their profit margins are growing. So as a result, we assume the business is going to get better, so we'll pay a higher multiple than what the market is. But with Tesla, it's like people just don't even pay attention to what it means for a stock to grow. They just buy. It's like people, they're so used to seeing it climb that a lot of people aren't comfortable with the market drops. And so what I'm curious about personally is that I would like to get back involved in Tesla, but I could never justify paying these prices for the stock. I would say maybe I would pay under $1,000 per share, but it's kind of difficult because even at those ratios, the price to earnings is still in the several hundreds, which is still, compared to the S&P 500, for example, if we're just trying to compare to a broad market index fund, it's sitting at 20. So you see that it's too much, and I'm happy for the company. I'm happy that, that kind of technology is growing, but I personally, as an investor, would stay away from it. So Intel, as a lot of us may know, after this most recent earnings, announced it had to push back on its newest 7nm chips, and as a result, the stock tanked. We see that it fell on June 23rd. It fell almost 20% in basically 2 days, and it's kind of been idling around. What I find interesting though is that this is a company, it's not like AMD, which is growing dramatically. It's a bigger company. It's worth $210 billion, but the price to earnings is super cheap compared to its sector. We can look at companies like Nvidia, for example, or AMD, their direct competitors. Price to earnings ratio $162. I mean, yes, they have growth, but still, Nvidia 95. These are companies that, yes, there's potential for growth, but Intel still is the market leader. They still own the majority of the market. They produce great earnings. They beat on earnings this last quarter. They beat on revenue. They sell more chips than anybody. And I think that one of their biggest downfalls is that they like to do everything in-house. They don't like partnering with other companies. So as a result, they take longer to do their research and development versus a company like AMD that's been growing its market share. It likes to partner with other companies like It likes to partner with companies like Taiwan Semiconductors because it's easier to manufacture large numbers of chips if you don't have to manufacture 50% of the process. Sorry, sipping coffee. We do see though that the CEO announced that they're going to be accelerating their stock buyback. We'll see a click on this right here. They're going to be purchasing back $10 billion worth of shares because the stock is too cheap. And I agree. You can use something like a discounted free cash flow. It's basically an investment strategy formula. You can plug in any company and get a fair value of the company, or what the company technically intrinsic value should be. This is also assuming that we're not counting in speculation or anything like that. We're just going to be plugging in key fundamentals like their margins, their profits. We're going to check out to see what's going on inside of their portfolios and see where the business is going. But ultimately, you use that input of the discounted free cash flow, and the fair value of the stock is in the 90s. So it's like clearly the stock is, at least, even if you don't think it's quite worth that, and we'll take it with a grain of salt and say maybe the fair value is worth 70. It's still, this company is still trading at a price of $50 a share. Like, it's clearly undervalued. It's kind of plateaued. You can see since about 2017, it hasn't really moved much. But you also have to remember, this is a stock that pays a decent dividend. So if you're a dividend investor, it pays 2.7% guaranteed. So you got a guaranteed return no matter what. It's trading way cheaper than the rest of the market. They're still dominating in the market. And currently, they just need to fix their manufacturing when it comes to their 7nm chips, and I think they'll be fine. And I honestly don't see this company collapsing or going out of business. Yes, they have some debt, but their debt to revenue ratios are it's not even worth comparing their debt to how much money they make, because as a result, they're really a core fundamental business in the US economy, and I don't think they're going anywhere. So me personally, I have been adding this position to my portfolio. I'm not going to disclose exactly how much, because I personally don't think that it's super helpful a lot of the times to show people exactly what I'm investing in, because I would hate to see people mimic what I'm doing and say the markets fall 15%, and I'm expecting that, but they're not. And the market falls, or their portfolio falls faster than the market because they're investing more in individual stocks, and they panic and they sell. Versus me, maybe I'm investing in these stocks and then I see a 10-15% pullback from current prices. Well, knowing me, I'm a contrarian. I like to buy things when they fall, so I'm going to dive in even deeper into the companies that I believe in, but someone else might not. So that's why I always expect people, just do your own research. If you're not comfortable investing in individual stocks, that's fine. Just buy the index. Buy it every week. You could buy it every day if you wanted. $5 a day, $50 a week, whatever you got to do, and just get into the market. That's something is the hardest issue for most people, is consistently buying into the market and consistently just having it passively grow. Like, it's hard when you see the markets fall to want to be like, yes, let's buy more. But ultimately, that's the time you really should. And on top of that, if you're buying as a broad index fund, you shouldn't really care where the markets are at right now, especially not when it comes to someone who's in their 20s or 30s or even 40s. Your time horizon is so long, it really doesn't matter. I personally just like to buy the market in general every week, and I also like to buy individual stocks because I like to get a little bit more involved, obviously, because I make YouTube videos for it. But my point still stands that, unfortunately for most people who watch this video, or most people in general, they don't ever invest in the stock market. They never take that risk. They never push themselves to do something like that, because they either think it's a scam, or maybe they can't handle the volatility, or they don't know really what they're getting into, and something unexpected happens, and as a result, they panic. But the important thing about the markets is to understand is that it's a slow process. It takes time, but if you stick with it, you'll become a very wealthy person. It's just all about being consistent. Anyways, I know it's a short video. I hope you guys enjoyed, and hopefully I'll make another one in a week and not 3 weeks later. Anyways, have a good day, guys. If you have questions, just let me know. Links are going to be down in the description if you want to sign up for a brokerage account with Robinhood or M1 Finance. If you use the link below, you get a free stock. You don't have to use it if you don't want to. If you want to set up your own account, I totally get it. But if you do, sweet. I've never actually gotten free stock from anyone opening an account, so that'd be interesting. But anyways, I hope you enjoyed again, and yeah, we'll talk to you guys soon. Cheers.